I'm going to bring in Gibbs Wealth Management's Aaron Gibbs, the Lancey Strategies President Jarrett Levy, and Kingsview Wealth Management CIO, also Fox Business contributor Scott Martin. Let me start with you, Aaron, because I got to admit, you've been ahead of the crowd. You were on cyclical names. You talked about them a lot. And, of course, now they are benefiting from an improving economy. But you can almost argue that some of them look like they're getting expensive, and growth may be getting oversold. So are you making any adjustments yet?
No, I don't see them as really turning or having any change in trend. While they are getting more expensive and growth, I wouldn't call it quite oversold just yet when you look at some of those valuations. But just taking example, one of my favorites, financials, the financial sector is still trading at a 30% discount to the S&P 500. And that historically is an extreme discount, even in a low yield environment. We're normally talking about a 20% discount, not 30 to 40. Right. So I still don't see this as overbought by any means, and there's still room for it to grow.
All right, Scott, a gusher of money coming in has got to go somewhere. How do we get positioned for it?
I think it goes to stocks, Charles. And to Aaron's point, just to dovetail that, we actually took some money from, say, weakened tech to the beaten up tech last week. And what that means, Charles, is looking at things like Square, looking at things like NVIDIA, DocuSign, Teladoc, things that got way blasted down to linear regression support lines, as well as things that just got, frankly, oversold on, say, the RSI and the MACDs to get technical on you. And so those are areas, too, to your lead in there, Charles, where I think you can start picking up some positions. And that's what's going to make a good stock picker this year, is waiting for those stocks, those high flyers from last year, yes, to come back to you at a price level where you can take another bite.
I'm inclined to agree with you that the stay-at-home, the tech side of that, probably way oversold. Someone, in fact, a third-tier firm put a sell on Square today. So to your point, they're on my watch list as well. Jared, how are you playing this?
I like everything that Scotty said. I think that the way I'm kind of spinning it is I'm looking for two things. I'm looking for sort of those transformational names that maybe haven't gotten all the love. I'm liking Best Buy right here. They're transforming into digital. We've got all this sort of pent up potential in consumers that are now getting back to the streets. They've got savings. They've got cash in hand. They've got optimism. I'm trying to play that. Also looking at Johnson & Johnson here. A little defensive, but I don't think people are taking the efficacy and convenience of their shot, plus their everyday, sort of play to the consumer as seriously as they should. So I like those two names. And that's what I'm kind of moving into here. We're watching for some of the high flyers in leisure. There has been a lot of big buying in like PEJ, which is an ETF that buys a lot of leisure. Watch out on those names. I don't know if I would be gobbling up here. I'd wait for a pullback.
It's so weird, too, with the staples, right? I mean, they had a flash at the very beginning as a defensive place, and then they have been totally underwater. Let's stick with this theme, though, the consumer. We had sentiment numbers out this morning, came in stronger than expected. It was powered by an almost 10% spike in expectations. So we're feeling more confident about 6 months down the road. In fact, the second highest level since last March. In addition to that, L Brands posted a strong financial result. They upped their first quarter guidance, almost doubled it to 65 cents from 35. They've reinstated the dividend for the year. It's going to be 60 cents. This company following Gap saying it's going to be a huge year. Jared, I'll go back to you. First, I'm going to take a victory lap because last year I was pounding the table. I told people to buy brick and mortar retail, and they have gone through the roof. In fact, I still own some Gap stores at 13. What about some of these other names? Because, again, it's so crazy. When Wall Street seems to be warming up, a lot of these names have taken off to the point you wonder if you missed it.
Yeah, I think there is some room there. And by the way, kudos on that call. I know you've stuck with this one. And sometimes it's hard to do, right? I think what we've got to remember is this. Remember, pent-up consumer demand. We just had a year of pretty rough times for a lot of retailers, a lot of brick and mortar guys that had to kind of reinvent themselves. So right now you've got these lean, mean fighting machines that when the consumer returns to their normal buying levels or normal activity, a lot of them will flourish. I think you've got to look at a name-by-name basis. I think you need to be sort of, again, careful just going out and buying a retail ETF.
Right.
Again, the Macy's of the world, I would watch a little bit. Some of the smaller plays that you were talking about, Gap could be interesting. I think you just got to be a definite stock picker there. Just don't go buy brick and mortar retail. But I like the sector. I think it's going to continue to perform generally well.
Aaron, a lot of people have going to have money burning a hole in their pockets. I mean, how do you position for that?
Yeah, so I'm still hesitant about a lot of the apparel retailers. I mean, I think L Brands is different because they had the Bath and Body, which really helped them. But aside from that, when you get all your new clothes, you want to go out. So my idea more is look at restaurants, look at leisure, right? You got these new clothes. So
Okay.
Darden
Yeah.
restaurants, a little more upscale. It's not your fast food that we've been living off of. And so I think Darden restaurants and those types of slow fast food, family eating, it could really take off over the next 6 months.
Oh, I agree. I was trying to figure out a way to take this equipment out of this room and to the front lawn. That's how beautiful it is outside and how eager it is. I want to get out there. Hey, Scott, let me ask you about gold. There was a report out earlier this week. It's not living up to the hype in terms of being a hedge against inflation. Is it time to reconsider some other hedge against this inflation story that won't go away?
Yes, I believe it is, Charles. And you know I've been a gold lover, and gold was great last year. I mean, gold really helped out our portfolios as far as reducing volatility. So it did serve its purpose, and now it's just not doing much. So there's two things. One, I think that love has kind of gone to Bitcoin, which obviously we've seen take off while gold has kind of slumped. But I'll tell you, man, if there's real inflation out there, and this is true due inflation that's coming down the pike here, Stocks are going to be that hedge because you're going to see the inflation pace pick up in stock prices. And so I think stocks here are a good hedge against any inflation expectations that we have.
I got to ask all of you about this report out saying that stock pickers underperformed the market yet again. 11 straight years of lagging the S&P 500. I'll go back to you on this first, Scott. I mean, what's the argument for professional stock pickers?
Well, at least for ones like me, I hate to say it, but we actually did beat the market, so I don't know who we're talking about. But you can go back on the tape, Charles. You know, I like something that Aaron talked about because we talked about stuff like Darden restaurants. We talked about stuff like Bloomin' last year. We talked about Southwest Airlines. I said, I love Southwest Airlines. LUV is the ticker. So I don't know how these stock pickers missed it, but you've got to stay with good themes, and you have to be able to deal with volatility. I think on some of the stock pickers I've seen and looked into, they sell too early or they sell too late, and they don't hang on.
Jared, I got to tell you, I do find the data to be very suspicious, particularly last year, because the winners won big and the losers lost big. And I don't see how, some of these general funds could have beaten people who really just saw things like we talk about on this show every day. But what do you tell someone who says, well, maybe I should just buy a regular old ETF?
Yeah, there's two bits to this, right? I mean, Scotty's right. I look at my numbers. I look at a lot of my colleagues' numbers. They're doing great. Here's the thing that you got to remember, right? When markets are sort of straight up parabolic in one direction over a long period of time, everybody's a genius. All of my friends, all of my doctor buddies are out there like, dude, I'm killing it in the markets. Yeah, you are, because stocks do nothing but go up. Now, remember, as pros, we're diversifying. We're buying insurance. We're spending money on the just in cases, and we're also protecting ourselves for when the turn does come. So some of that money, some of that upside might be spent on, protective measures. So I would think that's the general theme that as an investor, you got to think about. If you put your money just in an ETF and let it sit there, be prepared, like Scotty said, for some volatility and a wild ride, whereas a professional is going to massage that a little bit. And usually when markets are volatile, they will return less volatility than the average.
That reminds me of our old colleague here, John Stossel. He did a show once where he put a bunch of symbols on the dartboard and threw darts. And then at the end of the year, he said he outperformed the market. But he didn't deal, Aaron, with the emotions of it. You buy Boeing, for instance. How many people have sold Boeing at a loss in the last year, and now it's through the roof again? The emotional part of this, I think a lot of people have to understand. In hindsight, it looks easy.
It does, and I think part of it is really sticking to our convictions and understanding the thematic changes. And certainly with the advent of ETFs, it is harder for managers to beat. And we've known that. The more ETFs there are, the harder it is for active managers to beat. But when you look at big changes years like 2009, 2010, those are the years where active managers actually beat. Same with 2003, 4, and 5. So when you see big thematic changes, those are the years where managers can really help and you look ahead and stick to their themes and beat the market.
And the last year and a half has been all about themes. I'm telling you, I think only less than 60% of the stocks in the S&P were winners last year. You really had to be spot on. Aaron, Jared, and Scott, thank you very much. And that's why I had this conversation with you, because you all have amazing, impeccable track records. All right, folks, the ramifications.